And joining us now to discuss the jobs report, which showed a better than expected increase of 165,000 jobs, is Jeffrey Bergs. He's professor at the University of Notre Dame, and he's also a former economist for the Federal Reserve Bank of Boston. Thanks so much for joining us. And we've got Phil in DC who's also going to participate in this discussion. So, Professor, the unemployment rate is now at its lowest level in 4 years at 7.5%. What's the most significant takeaway from the April upside surprise?
I think the most significant takeaway is that the labor market is really shoring up in terms of confidence. And this is what I think we're seeing in terms of the financial markets, in terms of the performances, is that I think there's a belief among business leaders that the recovery is very solid. There's an absence of headwinds out there, and that it will continue to grow and we'll continue to see modest growth in terms of employment.
Absence of headwinds, that's quite a big statement, Professor, because if we're looking closely at the report and digging beyond the surface, it may not be as positive as it appears. Some analysts felt that the details behind the headline numbers still point to an economy that continues to struggle. For example, construction employment fell. The payrolls in the manufacturing sector also remained flat. You don't agree that these are concerns?
I think we're always going to see volatility in terms of the composition of the employment changes. I think what we're seeing, though, is a slow, steady progress in terms of the employment situation. I think that what this basically bodes is there's sustainability in terms of the growth rate in terms of the economy. Now, we're not talking about gangbusters growth exceeding 3% over the course of 2013, but I think we're expecting between about 2 to 3% growth. And I think the financial markets are happy with that. A very important aspect is that inflation is under control. Also, wage growth is under control, but there's been good productivity growth, and that shows up in corporate profits.
Philip here in Washington, Jeffrey, I sense the optimism from your side there. Look, Europe has been a disaster for the past year. There's been a slowdown in Asia, but the U.S. market continues to chug along. I would argue that perhaps maybe despite all the concerns around the world, are you surprised that this report is as strong as it is? And what does it tell us about the upcoming months coming up?
I think there are a couple of things to keep in mind. Granted, the Eurozone is in recession, but it's not in a deep recession. A very important thing that also came out is the European Central Bank lowered its interest rates by 1/4 point, saying further that they're going to be there to support their economy. So I think we have problems like the Greek situation, Italy, France. These are largely under control. These are the headwinds that I think have been embedded a little bit so that we're not facing the kind of shocks like in 2011 with the tsunami in Japan, in 2012 with what was going on in terms of the European markets. I think those are absent now, and that means kind of sustained growth. The other thing is while construction jobs were not notably robust, a very important part of our recovery is that housing has solidified. We're seeing an uptick in terms of housing prices, about I believe it was $10,000 rise in the median price of houses out there in the markets, and that is a critical figure to show that in terms of the housing market, it's solidifying, and that was a big gap that was weighing on people's confidence in recent times. Although, granted, payroll tax rise the first of the year and the sequestration is going to put a drag on the economy.
Professor Berg, certainly the housing market has fueled the recovery, and that has been in part, or by a large part, fueled by the Fed. But one of the concerning issues in this jobs report is that the number of people working part-time soared 441,000 last month. We saw an increase of people wanting full-time employment, but that they could only get part-time employment. So what can be done to encourage employers to hire on a full-time basis? Any government incentives? And more importantly, is this a consequence of Obamacare and those mandatory health insurance requirements for full-time employees that are deterring businesses?
Regarding the last point in terms of the Obamacare, I think we've yet to see. It's going to be very hard to determine what is the role of that going forward. Going back to the composition of jobs, a lot of them in the service sector, a lot of them at lower paying jobs. This is a concern. We don't have as robust an increase in terms of manufacturing jobs. A lot of the jobs out there are lower paying jobs, and we also have, and we cannot diminish the fact that many people have been discouraged because of the long duration of unemployment. They've been discouraged from being in the job market. That factor, though, as the economy continues to rebound, I think what we will tend to see is a little more encouragement by people coming back into the job market. But I agree with your concern that it is holding back per capita income growth because not all of these jobs are in very strong, high-paying jobs.
If the economy is going in the right direction, does the Fed still need to keep rates so low?
I think so. What we're at 7.5%, I don't think that we want to change things. The Fed has indicated they're basically not going to be raising interest rates until unemployment falls a full percentage point, down to 6.5%. That kind of unemployment is still a long ways off. We are not going to see anything like that this year. We will be, it would be good to see if we get unemployment down to 7%. So I don't think the possibility of raising interest rates is anytime soon, because in the face of the sequestration here in the United States, as well as the rise in payroll taxes, the Fed does want to ensure that this recovery continues to be on solid ground, and that necessitates keeping interest rates low for quite a while.
Jeffrey Bergstrand, professor at Notre Dame, thank you very much. Thank you, Michelle, as well.